All right, let's level up our financial sophistication and let's navigate to a singular report that gives us all the information we need. Now, for the purpose of today's example, we are focusing on management reports, but for today's example, I'm going to be doing a screen share with Xero. Now, if you're running QuickBooks, MyOb, or any other platform, you will be able to find a variation of the management report. But what I'm going to do today is I'm going to show you Xero. I'm actually going to use one of my own companies, one of the smaller ones, just to show you some real data and also walk you through exactly what I look for in the report and why. So what I'm going to do is chuck a screen share on. You can see we're here in the Xero dashboard. I'm going to navigate to accounting. If you haven't got favorite reports yet, you could select reports, but my management report is in the favorites. So I'm going to select that there and open up this management report. We're going to have a bit of a walkthrough of the things that I look for in order to manage the business. Now, this is a report that not only I produce with my one-on-ones, but this is also a report that all of our managing directors and our CEO and our executive team all use around the country, regardless of what the company is. This is our best snapshot in time on a monthly basis. Now, this report, it grabs our three financial reports. It grabs our P&L, our cash flow summary, and our balance sheet. And it also grabs two other reports as well. It's our accounts receivable and our accounts payable. So our debtors and our creditors. These 5 pieces of information, these 5 separate reports, are then compiled into one, and it gives us what we can see on the screen here, an executive summary. Now I'm going to walk us through line by line of the important things, and I'm also going to tell us what we don't necessarily need to worry about as well. And the idea by coming out of this, you will not only be able to produce this report in a matter of seconds, but also you will be able to then factor this into your monthly review of the company, maybe a monthly business review that you hold for yourself, in order to make sure that you are achieving your targets. Now, if you have a project team or a leadership team, I would absolutely be including them in this meeting and this discussion so that they can also understand how the money moves within the company and, quite frankly, how little is left over as well. Because I think that's something very important. If you've got a project team and they are privy to job information, they're probably going to be led to believe that the company is, well, a lot more profitable than it actually is, because they don't have to see any of the activity statements, they don't see any BAS payments, they don't see money coming in and out, they don't understand the credit facilities and everything else that happens on the outside of jobs. But let's just focus on the numbers for today. So let's go through line by line, or actually a little bit of navigation about how to use our management report first. We've got our date set. It will always automatically go back to last month in comparison to the month prior. So for this, we've got April 25 versus March 2025. You could absolutely change this to last quarter. You could also change this to financial year to date and have a comparison of the previous financial year. And I would love for you to explore the different date ranges and the different information that you get out of there, because as you increase that date range, you obviously get a larger sample size. And then when we talk about averages, you do get, because of that larger sample size, you do get a closer average to what is true. Now, the only component there is if the company was significantly different 9 months ago to how the company is now, if you'd taken on an extra project manager or your first project manager, if you had moved from being on the tools to off the tools or any of those major moves, a lot of the data that is old is also going to be slightly irrelevant. So if you've made massive changes, doubled revenue, things are growing, you're investing in a commercial warehouse and a whole range of other things, I would probably limit yourself to maybe looking at last quarter versus the quarter before, and also last month versus the month before. But for the purpose of this, let's just look at last month and have a discussion about the different data points that we have here and how we can make decisions based on those as well. So the sections that we have for our executive summary are cash, profitability, balance sheet, sales, performance, and position. All of this information here comes from the stack of reports that are compiled in, and you can jump into each of those reports to diagnose a specific area as well. This is a great report to export out as a PDF and print off so that you can draw on, because I know that looking at it for the first time, you're looking at it and going, holy shit, that's a lot of data. I wouldn't mind putting some notes on things so that I can understand what they are. So if you need to take a moment right now, go for it and print that off. Okay, we've got our printed report out. Let's have a look at what each of these items are. So in our cash section, we have our cash received. That's how much money came into our bank by the end of the month and also by the end of the month prior. And we also have a variance there. We would like to see our cash received go up, our cash spent as well. That's how much money left our bank account for last month and also the month prior. And we would like to see that not going down too far. We would like to see our money spent remaining pretty constant. Now, our cash surplus is really the main component that combines the two together of cash received and cash spent. And this is the first piece that I look at whenever I'm analyzing anybody's company, because I want to see a trend. And the trend that I want to see is cash surplus, cash surplus, cash deficit. So it'll go surplus, surplus, deficit. And the reason that there is almost always a deficit on the third month is because of our BAS payments, because of our ATO payments. That will almost always put us down into a pattern of surplus, surplus, deficit. We want to be following that. If we have deficit, deficit, that's an area where we need to go, right, what is happening? Are we scaling up really fast? Did we just spend, an extra $60,000, $70,000 on materials? Did we just set up a new truck? What was the purpose for our cash to be in deficit for 2 months? Or did we perform quite poorly? Did we not have the profit margin there that we needed, and that's causing our cash balance to go down? So that's the first area that I really look at, and our closing bank balance. How much is left in the bank account at the end of the month? That is a little snapshot into how to understand how the cash flow is moving through the company, how cash and money moves through the business. Now down to profitability. Obviously, we all know our income, and we can see there the change. And what we're looking at is to see our income obviously going up, our revenue going up, but that's slightly overly simplistic, because we both know that we have revenue targets from our financial forecast, and all we want to do is make sure that we can meet our revenue targets. Our direct costs. If you're using a large amount of subbies or casual staff, your direct costs will increase proportionally with the amount of revenue that you use. If you have got all of your guys on salary and wages, your direct costs will no doubt stay relatively similar. So they will be almost like a flat line. Now in your direct costs as well, you will have your materials, but your materials will effectively be a percentage of trading income. So we should see direct costs remain relatively constant unless we're bringing more people in. And every new person that we bring in will obviously see those direct costs increase as well. Now we've got our gross profit. Gross profit is effectively direct cost minus income will leave us with our gross profit. And we can see here that we've got a consistency going on in our gross profit as well. Now these are cash balances. If when we get a little bit lower down to performance, we'll be able to see that gross profit as a percentage of income as well. Our other income, these are whether you sell vehicles, whether you have investments. This is just our other income line, as you know from your P&L. And then we've got our operating expenses or titled expenses here. We also want to see our operating expenses remain relatively constant. And we've got our profit and loss. As we can see, my company here for over the past couple of periods didn't perform very well. And that's just a sign of the time of year, and it's also a lot of work that the company needs to do in order to get back into some larger projects. Now we've got our balance sheet. We've got our debtors, so that's our accounts receivable, how much is owed to us, and our creditors, how much do we owe to our suppliers. This is good for you to track as well, because if you identify that we have a cash surplus up in the cash section, a cash deficit, and we have had 2 deficits in a row, but we can also see that our debtors went up, our accounts receivable went up significantly. We may need to put a little bit of work into collecting some of those invoices and collecting them fast so that we can turn that cash deficit into a cash surplus. Same thing with our creditors. If we have a large amount of creditors and we are running out of cash, we may be able to contact those creditors and just say, look, we need 7 days extension in order to make sure that we're managing our cash flow there. And our net assets. I don't generally pay too much attention to our net assets. And the reason that I don't is because quite often our balance sheet can accumulate a lot of junk. And particularly at this point in business, unless you are well versed in your balance sheet, we really want to make sure that we're focusing on our cash and our profitability first. And then as we get a little bit more sophisticated and we learn a little bit more, and we also have the mental capacity to do so, we're then going to start to hammer our accountant on pulling apart our balance sheet and making sure that some of our assets and our liabilities are assigned appropriately, and that we're not carrying any baggage. The balance sheet can tend to be like, I don't know, like the spare room in your house where you just end up storing shit and you don't really know why it's there, but you hang on to it anyway. And we'll get to the balance sheet in future programs. Now, sales. This is probably an area that you haven't really been exposed to because you haven't seen this kind of report before. But I've always found this very, very interesting. The two components we have here is our number of invoices issued and also our average value of invoices. Now, our average value of invoices always trumps people because everybody wants to say, oh, but I do $300 jobs and I do $30,000 jobs, or I do $10,000 jobs and I do $100,000 jobs. This average value of invoices is a game that we play that Xero collects for us, but it's a game that we play to just drive our average value of invoices up. Now, if you do a deposit, a progress claim, a claim two, we do, and then a final balance, and you have those 4 invoices, you would be able to reverse engineer this and say, if our average value of invoices is $1,200, I'm going to times it by 4 to get our average job value. Now, we want to make sure that, 1, we are driving our average value of invoices up to the point where we can't drive it up any further. So if you're doing maintenance work, there's only so many big jobs that you're going to do. But this is a good chance for you to analyze, are we doing more big jobs or are we doing more little jobs? And you may have an example here. I mean, let's use the live numbers that we have here. 196 invoices were sent at a total value of $1,200 per invoice. Now that would say that in comparison to the month before, we did almost the same revenue, but we did 37% more invoices. So that would have felt like a really busy month. It would have felt like we were doing a lot, but we didn't really achieve much more. So the analysis that my team will have, that the Bill Cleanwood team will have on the back of this is, what did we change? Did we change anything in marketing that resulted in us getting more smaller jobs? Or was it just a sign of the time where a lot of residential projects were handed over and we didn't have any big commercial projects on? And judging by the low revenue, I would say that that is most likely the case. And the team will then go back to estimating and they'll say, what caused us to not win enough commercial jobs? What caused our average value of invoices to go down by 15%? Why is that not up to our target of $2,500 or $3,000? So this is a very important piece for you to watch as well, because it enables you to have a look at what is the effect of our marketing and our sales function and how does that relate to the numbers, and the numbers do not lie. Now down to performance, at our gross profit margin and our net profit margin. Now our gross profit margin in this report dropped by 12%. This means absolute chaos. And in the previous videos as well, you would have seen that we talk about a safe working range, and a safe working range for this company here is 42% and 38% gross profit margin. So the previous month, it would have been okay. That was okay. But the month that we've just had in this April period at 35.77%, that fell below the safe working range, and the team will be moving hell and high water to get that back on track. And we can also see those net profit margins. I would have drawn a conclusion here as we've had a look at from the sales section, the average value of invoices and the sheer volume of invoices that were done. I would say that in the team meetings, in the managers meetings, they will be having discussions about why is revenue so low. And that would be causing the low net profit margin, because gross profit margin at 40 and 35% are relatively close to where they need to be. And that March marker at 40% is where it does need to be, which leads us to say that the team are working efficiently on site and the quotes are lining up well. It's just that we have a large amount of operating expenses, which means that the net profit is really low for that period. So the team would be pushing back and saying, back to the conversation of why is average value of invoices so low? Most likely because there was not enough commercial projects. Also, revenue is too low because net profit is not there. So we need to get out there and we need to get on site and we need to get tendering on commercial projects to bolster that side of the business up. That is and we're working through a live analysis here, but that is most likely the conversations that they are having in that office at the moment. If we move down to return on investment, I don't tend to look at return on investment here as well. It has no real relation to us making operational changes based on our numbers. And then our position. There's only a couple points here that I really look at in our position, and this is our average number of debtor days. Now we could see that going back up to the top, the closing bank balances are really quite low, and also the average debtor days are really quite high. If we're a residential and commercial construction services, so subbing to builders in resi and commercial, we would see that half of the work would be on 30 days end of month, half of the work would be on 14 days. We should really be seeing an average debtor days somewhere around 30 to 32. However, the average debtor days that we're reporting here for the past two periods are 50 or 49 days and 39 days. So that then pushes back to the accounts team and say, what the hell is going on? Why is it taking so long to collect? So we've gone through also our average creditor days. We can see that we no doubt held on to some cash, spoke to some suppliers and said that it's going to take us a little bit longer to get back to you for those payments. And that's where that March is probably sitting at 48 days due to conversations like that. But then coming into April, we had some cash in the bank and we were able to pay those bills off. So that's dropped that down for April. I don't worry about the three pieces below that: short-term cash forecast, current assets to liabilities, and term assets to liabilities, because it doesn't help us make educated decisions at the moment. So I hope that gives you a really good understanding of a live example. I wanted to use a real company example so that you could see exactly how it should go. And I hope this has been hugely beneficial for you. And I would like for you to roll out a meeting like this within your own business so that you can know your numbers, and that so that you can also make the right decisions based on the story the numbers are telling you.